Good evening and welcome to another episode of Poor vs. Standard. This is the Options Plays edition, where we teach you about options with the visuals that we first started our podcast without. So, for your approval, I submit to you how we will do calls, both buying and selling. We're going to recover the calls that we did the last time as far as the buying side, and then we're going to go into the selling side. As always, none of this is financial advice. Any opinions within this podcast are for entertainment purposes only, so don't sue us. Don't do it. And if you feel that you get any value from these, please feel free to join our Patreon. You can find us at patreon.com/poorvstandard. You can find us on Twitter at vs_poor, and you can always email us at poorvstandard@gmail.com. All right, with that out of the way, let's get into it. What do you say? So, I apologize if there's any type of background noise. It is over 90 degrees here, and I have an air conditioner running in my window because I am hot. So I will try and edit that out in the post-op, but we'll work with it. So let's go into calls. We're going to do this on AMC because that's the talk of the town right now, and I feel like that'll get us more play. So, obviously, today is June 29th. You can see we have July 2nd calls here. We're going to do some calls for, we'll say August 20th. That sounds good, right? So, the first one we're going to cover are the calls in thinkorswim. And after that, we will actually do calls in Robinhood. Maybe, if it works. If it cooperates. If it doesn't, well, sucks to be me. There we go. Okay, sorry about that. A snafu on the Robinhood website, which is why I don't use them anymore. So, first things first, we're going to start with the AMC on thinkorswim calls. So, as you can see, the current price of AMC is $56.65. It was down $1.46 today. But we're looking at August options, August 20th. And currently, the $55, which is the barely in the money, so we would call this the at the money call, is $15.90. So if you click over here, it'll encircle it in a box, and you'll see this little green thing, which means you're buying the option. If you were to click over here, that means you're selling the option, and you'll see a little red thing indicating a sale. And that's the call side. Over on this side of the 55, you'll see the puts. And you can see the prices here, and the same thing happens. If you click this one, that's the sale. If you click this one, that's the buy. If you click it again, it comes off. So then you can come down here and review it if you'd like. Here we are. And you can see my other options plays, and it always puts 10 in there when you do it. Son of a bitch. August 1st, August 20th, one of them you're selling. You can click it over to buy, because that's what we would do. The $55 call at $15.50 is what you're buying. So if you come down here, you'll see that this will calculate your strike price and everything for you. So this is the $55 call, so 55 and above. You can see that you're still in loss up until you hit that $15.50 above $55, so $70.50 is your break-even point, and it calculates that right here. And then the further up you go, the more profit you have. And you can see in the upper left-hand corner that it's calculating your profit as you go, based on today's date and based on the date of expiration. Sounds cool, right? Easy enough. That's the call. And if we sell it, you can see here that you would be receiving $15.50. And so right over here, that's your maximum. The further down it goes, you will never make more than $1,500. Well, $1,550. The higher up it goes, the more you will lose, which means you have an infinite loss. If AMC were to go to $200, you would be so far boned. So just keep that in mind. And this is kind of why there's that whole short seller problem thing, is because the higher it goes, the more money they lose, and it is uncapped, infinite loss. See? And so that's the problem that short sellers run into. And that's why you don't sell naked calls. You can sell a covered call, but we'll get into that in the next episode. These are just short things. Alright, so if that follows and tracks, let's go over to the Robinhood side. Okay, so if you take a look over here, the $55 call, which is the one just in the money, over here is $15.70. And you saw over here it was it says $15.70. That's weird. Strange. How's it change? Okay, whatever. My mistake. $15.70 is the average between $15.50 and $15.90. So I was mistaken when I said it earlier. So if you look over here and just click, you've got buy a call, and that's the price on the $55 option. You click that, and it'll tell you right here, your total cost is $15.70. Easy as pie. Expected loss profit right here. So as you can see, there's the $55 price. If it's at $55, you will lose the entire $15.70 you bought it for. And then it will show you all the way up through as the price goes up. Right there, $70.70. That's your break even. And you will not win nor lose. You'll just break even. If AMC's at $70.70 at the end of business on August 20th. Because we do have the August 20th expiration date up. And then, as you can see, the higher it goes, the more money you'll make. Unlimited. Right there. Now, if we unclick that, and we go to the sell side, Robinhood does something that's pretty cool. It gives you your chance of profit, which is pretty cool. So right now it's saying if you sell this, you have a 74.9% chance of profit. And why is that? Because it's already above that price right now. So what they're banking on is the fact that you're getting paid $15.70, which means your break even is $70.70. So long as the stock is under $70.70 by August 20th, you will still have the profit. So even if it's at $65 like that and 50 cents, you're still going to make $500 because you got paid $1,500. Now how does that work? Now that's because, so essentially you have shares that you will be buying at $55 a share, right? When you sell this call, you'll have to buy them at market price and sell them at $55. You are offering someone the right to buy 100 shares from you at $55. So if you didn't have any shares of AMC at that time when the contract expired, and it expires above $55, you have to go out to the market and buy them at whatever price the market has, and then give them to that person for $55. So if August 20th comes around and it's at $65.50, you will go out to the market and buy 100 shares at $65.50. Now, you got paid $55 a share. And then you also got paid another $15.70 on top of that share. And that's how you get to that $70.70 break-even point, because you're technically getting paid $70.70 per share to offer someone the option to buy 100 shares at $55 from you. So really, their price per share is $70.70 because they're buying this contract from you. So long as it finishes under $70.70, you make money. Now, if it finishes above $70.70, you lose money. So how do you mitigate that risk? You only sell calls if you have the shares already to back them up. That way it doesn't matter if it goes that much above, because you're not going out to the market and buying the shares because you already have the shares. So you're not actually losing. That's the covered call, and we'll get into that in more detail next time. All right, so thank you very much, and I hope you enjoyed this episode.